Welcome back to the channel, guys. Today we're going to get straight into the portfolio because we ain't got no time to mess about. So this is my Hargreaves Lansdown Portfolio. This is from a previous ISA year, a couple of years ago, and it was about 18 months of ISA that I was paying into this. So the total within here we've got now is 12,962, and boy has that been up and down the last few weeks. The markets have been pretty volatile. So I've got 12,962 is the value of the portfolio. I am £3,805 up. That represents a 41% return on this investment. I've stopped dripping into this from April this year. This year is 2021. So from April this year, I've started to open an ISA with Trading 212 because I wanted to try a new product. It was a fun product. I've had a good time with it. I'm not going to be renewing that next year, but that's a different story. So within this portfolio, anyone that's watched this channel before, you'll see that nothing's changed in terms of the holdings that I have in here. When I buy, I try to buy forever. My time horizon is forever. I'm trying to build wealth, and I'm doing that in the proven way that is the most successful way, which is buy and hold good businesses. So there's only 8 holdings within here. I don't really see any change whatsoever in the near or medium future with any of these businesses. I'm comfortable with them all. What I'm just going to do is touch on them, go through them, talk about what's been happening in the markets over the last few weeks, and hopefully give you a level of confidence around that. Actually, there's so much noise at the moment. The world of investing actually really, it's come a long way in terms of there's so much information out there. There's access to all sorts of people who are going to tell you all about different stocks and different dividends and different funds and different platforms that have come through, but some of it's really bad advice as well. So what we have to be aware of is actually one of the best ways proven to invest is to buy and hold for a very long time. As long as you're buying quality businesses, you're going to be good. The more you tinker with portfolios, the worse you're going to do. So I set this portfolio up a couple of years ago. I've got 5 holdings in here, which are funds that cover the world, and I have got 3 individual businesses which I thought were good plays, and I bought them. I still continue to think they're good plays, and when we look over the returns in a minute, I think you'll agree. First up is Aviva. Right, so I bought Aviva just over 14 months ago. It's a strong UK dividend business. You buy Aviva, you're going to get some good returns over 15 years. I have a relatively good confidence level of confidence to that. Not financial advice. Not financial advice, of course. I just think, for me, given my personal criteria, it's a good holding. So Aviva pays a dividend twice a year. Let's have a look at the chart here. So over the last course of the year, it's given some great returns. So when I bought it back in October last year, I have now returned 32% on it. It has been as high as 45%, I think. For a dividend business that pays, that's going to give you that sort of return, it's spectacular returns. But that is just because of the way the world has been over the last couple of years. We are not going to get years like we've had over the last couple of years very often at all. We are not going to see 90% returns within the S&P 500 over a 12-month period. That's not going to happen every year. What we have to do is we have to be consistent, and we have to be aware that there will be drops in the market like there's been over the last few weeks. We just have to not panic. If you've only been invested for 18 months or so and you've seen the markets drop as they have over the last few weeks, I guarantee there'll be people out there that have just been selling left, right and centre. It's not a time to sell. If you've bought into quality businesses, it's a time to top up into them. It's a time to grab a bargain. So Aviva has done really well for me. 33% return, which represents 175 quid, and I've had a good couple of dividends. This business, I'm going to die holding this business as far as I'm concerned. I really love it. There's nothing in there that gives me any cause for concern for the short term, medium term, long term. I don't even look at Aviva share price anymore. I don't worry about it. I look at the report, the annual report that comes out. I look at the interim report that comes out. I just have to check over that to make sure I'm happy with everything. They're still going in the right direction, and I'm going to keep holding. Ftse 100 is not, if not my worst, yeah, it is my second worst performing fund that I've got. So it's an accumulation fund. Accumulation, of course, means that any dividends are directly invested straight back into the fund, and you don't have to worry about it. That will continue to grow and snowball over time. But it's had a bad couple of years. The Ftse 100 has. It's pandemic. It's good old Boris with his cheese and wine. It's the slump in the economy. It's inflation. It's the fact that there was no jobs last year and there's not enough labour this year. It's a turbulent time. But during a turbulent time, I've got 20% return on my investment. And that's why I invest into the stock market. I've got a 20% in return on my investment within the UK. And the UK has been through one of the most turbulent 2 or 3 years in a generation. If I'd have put that into the bank, I'd have got 0.25% over the course of a couple of years, and it wouldn't have grown at all. As it is, I am £272 up on the Ftse 100 alone. And I just want to look at this. So this is the 5-year return for the Ftse 100. So it's 10% up, it's 4% down, it's 11% up, it's 6% down, it's 14% up. It's not a powerhouse. It's not a financial powerhouse like it once was, the UK, I'm afraid. But I don't know what the future's going to hold, and these things are cyclical. It could become the next US in the next 10 years, 15 years. Who knows? I keep it for diversification. I keep it because I know the market. I am always going to keep the Ftse 100 index. I actually have the Ftse 250 within my trading 2 and 2 portfolio. When you look at the chart, look right here, we know what that is. Basically, look at the trend line though before that, look at the trend line after it, and if you were to scan out even further, you'd see that that just continues back into the past. Past returns are no guarantee of future. Don't forget that. That is always the truth, and the UK could go into a 20-year recession and inflation could reach 10%, and anything and everything could happen. We don't know. That's why we diversify. That's why within this portfolio I am diversified across the whole world, across sector, across geography. That's why we do it. So the worst performing one has been the iShares Japan Equity Index, and that is just 17% up. Again, I'd have got 0.25% in a bank. I've invested into Japan. I have got 1,500 quid worth of value invested into Japan. Japan has struggled for 20 years. It was flying in the 80s and 90s. For 20 years now, it has pretty much flatlined. But when you look at a 5-year view, like this one, it's trending upwards again. And again, who knows what's going to happen in the future? The Japan could take over again and be an absolute powerhouse in the financial world again. We don't know. I'm going to continue to hold it until I die in my investment portfolio. This next one is the iShares Pacific X Japan. So that's an iShares fund that covers the Pacific, excluding Japan, of course. That has returned 27%. So that is a lot of developing countries in there. So developing countries are something that I want exposure to in my portfolio. Emerging markets, sorry, as we should be calling them. So I've got emerging markets fund within my trading 2 and 2 portfolio as well. I'm always going to invest into emerging markets. Now, the one thing that might change is I might change the actual funds that I hold, the specific funds. So this is an iShares one. It may be in the future I hold an HSBC one or whatever it may be. Given the fees, whatever is going to be the lowest cost one to do, that's what I'll look at in the future. At the moment, this is a relatively low value portfolio. I am paying a little bit more than I should, but nothing that I need to be rejigging and concerning myself with. So I'm comfortable enough at the moment with this. Europe is very similar returns to the one above, the Pacific X Japan, 27% return. I've got 1,800 quid value in here, and I'm 380 quid up. Again, I started this 2.5 years ago. One of the most turbulent 2.5 years within Europe, and I'm 27% up. Look at the 5-year view on Europe. It is pretty good. It is market beating, excluding this year, but the whole world struggled that year. That was a real downturn. So 22% up, 7% down, 14% up, 10% up, 11% up, nearly 16% up. Now, those sort of returns from a cumulative perspective, you're going to be doubling your money. I'm not going to do the math in my head right now, but probably every 6 or 7 years with those sort of returns. So the more you can get invested, the sooner you possibly can into a well-diversified portfolio. You then just need to let time do its magic, which is why at the moment I am trying to contribute as much as I possibly can into my ISA. I contribute a significant portion of my take-home salary. At the moment, I was hoping to get on track for maxing out my ISA and trading 2 and 2. I don't think I'm going to be able to do it, but that's what I want to be trying to do every year. If I can generate some side income, that's the whole purpose of this channel. Hopefully that will help me to bridge that gap in terms of being able to make it over up to £20,000 invested every year. Now, don't forget, you could be in a completely different situation. There are going to be people out there that are going to struggle to get 200 quid into their thing a year. There's going to be people that are going to think £20,000 is nothing, and they're going to be putting 200 grand a year away into these investments. Everyone's different, and you mustn't measure yourself against me, positively or negatively. You must do your own journey. You must have your own plans. All I'm trying to do is show my plan and hopefully inspire a few people to do the same sort of thing, because actually, it's dead simple. You know, I've already done 90 videos on this channel, and there's thousands of videos out there on what to do, but it is dead simple, right? All you do is you get a really diverse portfolio, heavy in funds. You put as much in as you possibly can, as soon as you possibly can. You make sure the fees are as low as they possibly can be, and you're laughing. Do that consistently every month, every year, and within no time at all, you're going to be very wealthy. And time is going to pass anyway. The time is going to pass anyway. So if you're worried thinking, oh, I can't wait 15 years for this portfolio to be worth anything. Well, 15 years is going to pass anyway. So you might as well put a bit of cash away on the side. And in 15 years time, you're going to be rich. It's a no-brainer to me. Shopify, I'm just short of 50% up. I love this business. I think e-commerce is so well positioned over the next 20 years. I think the next generation, so I'm a millennial, the generation after me are so much more versed into this world. There's going to be so many more people starting up businesses. There's going to be so many more people using e-commerce as a tool for their purchasing habits going forward. And Shopify have got a platform that I think executes against it excellently. And you just need to have a look at the numbers for Shopify. Have a look at their revenue and their income statements. You will see that every quarter they are blowing it out the water. At the moment, it's one I'm going to be holding for years. Let's have a look. Yeah, it is the most volatile business I have within my Hargreaves Lansdown portfolio. So it's a one I do keep a little bit more of a closer eye on. At the moment, there's no signs of me to worry about anything. That's a 10-bagger, in my opinion. We got a 10-bagger here inside 10 years with Shopify. I'm relatively confident in that with the trajectory that they're going in at the moment. That's my view on it. Tesla. Right. Tesla has been all over the place. I'm 150% up. As I've said before, I'm actually more than that because I bought it in March 2020 and I had to shift it across. It's complicated and it's boring. But I invested 300 quid into Tesla and it's now worth 2,400. So it's an 8-bagger for me. This one, it was just on the cusp of being a 10-bagger for me at one point. Never quite made it. It will get there. I have no question. I have no concerns about that. It is massively overpriced at the moment. I would not be buying into Tesla now. Not with any real conviction. Might be dripping into it. It is massively overpriced. The PE ratio is through the roof, but it is not a car company. Don't forget. I know it's boring and we say it all the time. It is not a car company. It is a revolutionary company that is changing the world. I'm going to put a link to a video here, which I did at the weekend, about a ETF from iShares, the robotics and automation ETF. These guys are leading in that sort of area and they are changing the world. So obviously I'm not going into the specifics and numbers in any depth in this. I'm just talking about my overarching view of why I've invested into some of these businesses. And that has been up 10%, down 10%, all over the place. A couple of weeks ago, this portfolio was the lowest it's been for months and months and months and months. So many people panicking all over social media, pictures on YouTube of fire, the market's crashing, etc., etc. Oh, it's a bloody nightmare because all you need to do is ignore it. Now that contravenes exactly what I've got here, which is a channel that talks about investing and talks about stocks that might be interesting in the future and talks about growth stocks and talks about Rolls-Royce and Virgin Galactic, etc. But those part of my speculative fund, so I always want to be really clear on that. I am a consistent investor that only invests into quality companies and I do so for the long term. I do not worry about dips in the market. If the market, I want it to drop. I want it to drop by 40-50%. I wish it could do that, and I wish it did that next month when I'm going to put my salary into it. I wish it did it the month after when I'm going to put more money in it, because I'm not touching this pot for 15 years. So I want it to drop so I can pick up bargains. Do not get worried if you're invested into quality companies that you've done your research on. Don't worry when the market drops. It's okay. S&P 500 is up 41%. This is one of those ones where I've been a victim of dollar cost averaging. I put a relatively sizable chunk in February 2020, just before it dropped, and I've been dripping in. If I'd have just put in all of this in, this is why I can't time the market, of course. If I'd have just put it all in March 2021, I think it would be about 120% up by now. But you can't do that because you'll never be able to time the market. So 41% now, I'll take it. And over the last 5 years, S&P 500 continues to be one of the best markets you can invest in. Some people say to just invest into the S&P 500, you do get diversification by geography because the companies cover the world. It's not diverse enough for me. I'm probably a little bit more conservative than that, which is why I've got other funds that are covering the rest of the world. All of the funds I own, as I mentioned, are accumulation. So we've got reinvested dividends happening automatically. With Aviva, which is the only pure dividend company that I have in here, I've got dividend reinvested turning on, so that happens automatically. I've got my fees coming out of a general invest account, so I'm not eating into the capital. If you don't have your fees coming out of a general invest account, they will sell your positions in order to pay your fees, so make sure you have that set up. This is a beautifully, perfectly positioned portfolio for my needs, given my strategy, given my targets, given my time horizon. Just wish there was more in there. That's the only thing I would change. Please let me know what you think about this portfolio. Drop me any comments below. And if you want to see my trading 2 and 2 portfolio, which is the one that's live right now for this tax year, I'll put a link to it here.